All right, well, welcome everyone to the crowdfunding panel. It's so exciting to see all of you here on behalf of the international section and the business section as well. This has been a great partnership. Jay and I have been talking about this for months now, so it's very exciting to see all the interest that we've had both via the internet and also in the room. So I wanted to thank also Dwayne Morris for hosting us and having us here for lunch. They've been, particularly within the international section, they've been a big supporter of many of our programs. So thank you again for Dwayne Morris for hosting us today. So within the international section, I'm co-chair of the Microfinance and Financial Inclusion Committee. It's just a brief word on this. It's a new committee that we started last year, and I thought I'd mention, because I get a lot of questions about, why is crowdfunding interesting to your committee? Why is it interesting to international section generally? As you'll see in the materials, the World Bank report talks about the potential for crowdfunding in the emerging markets, and the Jobs Act and the U.S. regulations have already, even though we're just starting here in the U.S., they've already served as a great model for other countries as they think about how they can have expanded access to finance for enterprise development within their countries. And so it's great to see that there are these comparative legal issues that we're able to use as models for other countries. So I just wanted to say a brief hello and put you in Jay's good hands as moderator of the panel. I hope you enjoy it. Thanks so much.
Thank you. Good afternoon. My name is Jay Hack. I'm a partner in the firm of Gallup, Dreyer & Berkey here in New York, and I'm the chair of the business law section of the New York State Bar Association. Let me welcome every one of you to the presentation, which we've been referring to as the first out-of-the-box chance to talk about the SEC's crowdfunding proposal. I want to thank the international section for co-sponsoring this with us, and especially thank Azish, who was instrumental in putting the panel together. In addition, I want to thank one person who's not here, who is Stephanie Bugos, who was our Bar Association liaison. If it weren't for her, you wouldn't have CLE, you wouldn't have course materials, you wouldn't know about this, and she's really the back office that makes all of this work. Now, we have 5 other state bar associations that are participating in this. We have 2 foreign bar associations, one in Europe and the Canadian Bar Association. We have multiple law schools also joining us. In addition, we're live streaming on the Crowdfund Insider. So how come there's so much interest in crowdfunding? Well, it's a potentially revolutionary process for small and emerging businesses to raise capital. Congress in the Jobs Act created a crowdfunding exemption from the registration requirements of the 33 Act. In October of this year, late October, the SEC issued a proposed rulemaking proposal to implement the crowdfunding statutory provisions. The rulemaking proposal is 584 pages before you get to the appendix. The SEC has requested comment on 284 different issues, and the comment period ends on February 3rd, 2014. First, I'm going to give you an introduction into what crowdfunding is and talk about investor limits. Then Georgia Quinn, to my right, will discuss issuer issues related to what issuers can qualify. Doug Elinoff will talk about issuer disclosure requirements and related issues. Layla Baum, who is from the Division of Trading and Markets at the SEC, and we've got to thank the SEC for sending a representative here, will talk about the role of intermediaries, including funding portals in these kinds of offering. Finally, Kieran Langham, who is at the far end of the table, who is general counsel to Seed Invest, will talk about practical implications of crowdfunding and various liability issues. At the end of each group of presentations, we will field questions, and those on the webcast can submit questions by email. You'll be able to figure that out. It's relatively obvious. Time permitting, we'll have a wrap-up Q&A session. Now, we got to go here. Let me just be. Okay. Modern crowdfunding is alleged to have had its genesis in 1997 when the American fans of the British rock group Marilyn got together as a crowd and raised $60,000 on the internet so their favorite bands could tour the United States. The website the website Kickstarter now raises money for everything from crazy inventions to space exploration. My cousin Sienna and her compatriots used Kickstarter to raise over $600,000 to start an institute for the performance artist Maria Abramovich. However, these solicitations all have one thing in common. They do not offer an interest in profits of a business enterprise. Thus, under the under the Supreme Court's Howey test, there is no offer of a security. Kickstarter-style offerings don't violate the securities laws because all you get is a concert t-shirt or a warm and fuzzy feeling. It is a completely different story if a crowd gets together, talks about a business opportunity made available to them through the internet, and then decides to buy an interest in the enterprise with the expectation of a profit. So then in 2012, along comes Congress and adopts the Jobs Act. They create a statutory crowdfunding exemption which allows offerings without a full-blown SEC-filed registration statement. The offering can be made to the public through an electronically accessible portal. There are required disclosures that Doug will discuss, but there is no full-blown prospectus and there is no advanced SEC review. Some people worry that crowdfunding will allow issuers to defraud the proverbial little old lady in tennis shoes, so we immediately ask, who is permitted to invest? The answer to that question is very simple. Anybody. There is no accredited investor test. There is no minimum education test. There is no sophistication test. There is no net worth test. And there is no income test. There is no mandatory suitability requirement. My 91-year-old mother, who is listening in, is permitted to invest in a startup issuing long-term zero-coupon bonds. Although the SEC uses the word suitable a number of times in its regulatory proposal, the SEC makes it clear whenever it uses the word that it is the investor who must decide whether the investment is suitable, not a broker-dealer or an investment advisor. Let me add that the Jobs Act does not distinguish between natural persons and institutions, and neither do the proposed regulations. The SEC has asked for comment on that issue, and there are a number of interesting questions related to differential treatment between individuals and institutions. But for now, neither the statute nor the proposed regulations distinguish between the two at all. So how much can an investor invest? Each investor has a rolling 12-month per issuer limit. There is no aggregate limit. The limit is rolling 12 months, and it's per issuer. The Jobs Act divides investors into two groups. First, there's those who have annual income or net worth less than $100,000 are in Group 1. Second, investors whose annual income or net worth is more than $100,000, those are in Group 2. So what happens if income is less than $100,000 and net worth is more than $100,000? Oops, the Jobs Act doesn't answer the question. In fact, under the Jobs Act, you're in both categories or neither category. So what happens is the Securities and Exchange Commission, in its regulatory proposal, makes the decision that I think and most people think is the only one that makes sense, and that is if you're in both categories, you're in the higher category. If you have negative net income because you're taking a lot of tax shelters and you have net worth of $10 million, you're in the over $100,000 category. Now, the annual maximum per issuer depends upon which group you're in. Start with the idea that everybody has a right, no matter what, to invest $2,000 per issuer per year in an offering. The homeless man on the street who won the $2,000 with a lottery ticket can invest it all in a single crowdfunding deal. Investors in the under $100,000 group can invest up to 5% of the greater of annual income or net worth. So that caps them at $4,999. Again, the greater of income or net worth is an SEC decision. the Jobs Act created a void here. As they say, there are two things you're not supposed to watch being made, and the second one is legislation. Well, this legislation didn't do very well in a lot of ways, and part of the reason why there's I said 580, it's 568-page regulatory proposal is that there are a lot of open questions that are not answered in the statute. This is one of them, and again, the SEC has taken the position that if your income is one item and your net worth is another item, you apply, which of course they're never going to be the same, you apply the percentage to the higher of the two. So in the case of people in the under $100,000 group, that percentage is 5%. In the people in the over $100,000 group, that percentage is 10%. If you're in both groups, it's 10% of the higher of the two. However, there is a maximum cap per issuer per 12 months of $100,000. Now, for natural persons, net worth and income are calculated using the regular Regulation D accredited investor rules. Now, remember that the SEC relatively recently revised those rules to exclude net value of primary residence from the calculation of net worth. So it's not as easy as it used to be to go over the $100,000 limit. The SEC has also proposed in the regulations that the net worth and income standards may be calculated either individually or combined with spouse, as is the case with respect to the accredited investor definition. The SEC has asked for a number of comments on the issue of spousal calculation. It doesn't appear that they have focused on, but I suspect that they will have to focus on how to calculate income and net worth when both spouses want to invest separately. As I said, these limits apply to purchases from the same issuer during a rolling 12-month period. There is no aggregate limit that an investor may invest in crowdfunding offerings from multiple issuers. If someone with no income and little net worth wants to put $2,000 in each of 10 deals at the same time, there's nothing in the statute or the regulations that prohibits that. And remember, these limits and the rest of the rules apply not just to individuals but also to entities. Thus, if Goldman Sachs wants to buy in a stock or any security in a crowdfunded offering, it is also subject to the $100,000 limit. However, don't cry too hard for Goldman Sachs because, as I'm sure you will learn later, crowdfundings are generally not aggregated with other exempt offerings. So if the issuer wants more money from Goldman Sachs will be able to buy more of the same security in an exempt Regulation D offering. Now, that gives you the basics on investors. Let me turn it over to Georgia Quinn, who will talk about what companies qualify to do crowdfund offerings.
Thank you very much, Jay, and thank you everyone for coming today. So now we're going to talk about issuers, the entities that are able to use these new proposed regulations to actually raise money. If there's one thing you know about Title III crowdfunding, it's that there is a cap per issuer of $1 million. So an issuer is not allowed to raise more than $1 million in any rolling 12-month period. And a lot of people think that that's not very much money, not enough money for a startup entity. So one thing to keep in mind, if you're of that persuasion, is that, as Jay mentioned, there is the opportunity to tack this offering on to other exempt offerings that the issuer may be doing, because that $1 million amount will not be integrated into other exempt offerings. So a company could potentially do a Reg A or a Reg D offering and then tack on a crowdfund offering, or vice versa, test the waters with a crowdfund offering and then tack on another sort of exempt fundraising.
By the way, I told you that Stephanie is at the Bar Association is here to keep us honest. She just reminded me that I forgot to do this. Go ahead.
All right, rules are rules. Another point about issuers is that they must be private companies. So they can't be currently reporting SEC reporting entities. Now, if a company is a voluntary reporting company, this doesn't apply. They could still take advantage of Reg CF. It's only for entities that are required to file SEC reports under the 34 Act. Also, only U.S. companies can take advantage of Regulation CF. So, no foreign issuers. And there is a bit of a disconnect here, because when you think about a foreign private issuer, oftentimes they're subject to a less rigorous set of regulations when it comes to conducting an offering. However, they cannot avail themselves of new Title III crowdfunding. The offering and the officers, directors, the issuer itself, and any 20% equity holder of the issuer cannot be considered a bad actor. If one of those participants is deemed a bad actor pursuant to this new definition, the offering cannot use the Reg CF exemption. So a bad actor, probably the best way to think about it is, right now it's a very technical list of activities and rules and things that a person or an entity has not followed, or crimes that a person has committed, but it's really geared toward financial crimes. So anyone who's conducted financial fraud or been evicted from an association that regulates the financial industry. Postal crimes actually constitute being a bad actor. But it's a very long laundry list, and you can find it in your materials. But probably the best thing to keep in mind is, it's financial related crimes, fraud, misrepresentation, lying to government agencies, things of that nature. Another point about issuers is that they cannot be investment companies or companies that are availing themselves of an exemption under the Investment Company Act. So that's most hedge funds. So investment companies and hedge funds are not able to use these regulations to raise money. In addition, the issuer must be an entity. So even though Jay's 91-year-old mother can be an investor, she cannot be an issuer. She would have to form an LLC or a corporation or some other type of entity to raise funds. Now, the type of entity is not specified, and so we can expect to see different types of entities that would make sense for that type of issuer. And then finally, the company must have a business plan. So no blank stock, no blind pool. You have to have a concept of what you're going to do with the money that you raise. You have to, there's no specific definition of what a business plan is, except that the SEC has given guidance that collecting money to acquire some entity that you haven't identified yet is not a business plan. So, probably, you would like to err on the side of being more fulsome and descriptive about your business. Also, it's probably not a bad idea to have your business plan if you're expecting people to give you money to bring that to fruition. So on that note, those are basically the highlights of what we wanted to cover, with a description of the issuers and a description of investors. I'm going to open it up right now to the panel, just if you have like a brief comment or something that came into your mind as we were going through this, and then after that we'll open it to the floor and to the web participants for questions. Doug.
Great. I'm very worried about Jay's 91-year-old grandmother already. Mother, sorry. You look so much younger than that. So what I want to point out, because it's often lost, and Layla will touch on it, or she actually will go into great detail, as will Kieran, you have to, Title III can only be conducted in an online environment, unlike Title II, where it can be direct from the issuer to the investors. That's not true in Title III. The crowdfunding, there has to be a crowdfunding platform or broker-dealer, and it has to be and will be regulated by the SEC and FINRA. So the 91-year-old better be tech savvy, because they're going to have to get to the crowdfunding platform. They're going to have to register. They're going to have to go through a process before they get to invest. So as a starting point, I think that's important for people to understand. It's not just somebody coming up to you on the street and asking you for money.
You have any questions out there? Yeah, go ahead.
Is there any rule on aggregation of issuers and related companies for purposes of determining what the maximum is for the group as opposed to one?
The rule says it's one entity and nothing. Anybody who's under the common control is aggregated to the million, and it becomes an issue. And we've discussed it as it relates to franchise opportunities, real estate opportunities. But the statute does speak to having a common control, and notwithstanding a lot of advocacy to take a different point of view, the staff has appropriately stayed within the confines of the statute.
There's been a lot of comment. There was a comment period prior to the proposal being issued. There's a lot of comment about how $1 million is too much. Is not enough, and that you need more money, and that it's inadequate. However, the statute says $1 million, and the SEC has taken the position that it would be inappropriate to use general exemptive authority to deliberately go against what Congress has established as the limit.
You can't have these hedge funds that have 3C1 companies, for example. Whose burden is it to identify or decide whether a startup business might inadvertently be a 3C1 company because it can do what it might do with cash it raises or what it currently holds?
Okay, and we're going to repeat the questions just so that people in the webcast have the opportunity to hear them. The question from the audience was, and correct me if I get this wrong, but we understand about an investment company that's already taking advantage of an exemption under the Investment Company Act, that entity would not be eligible for Reg CF. But what about an entity that, as it starts conducting its business, would fall under 3C1?
Or let's say you have to start a business or put a bunch of capital into investment securities and is inadvertently an investment company and couldn't line 3C1 exempt, but it's inadvertently an investment company, but with the intent to be a development of some business.
So it's a company that falls afoul of not, able to be an investment company and use Reg CF after it starts its operations, and who's responsible for policing that and what the ramifications would be. And, because the rules are, untested at this point, Layla?
Yeah, I can.
Sure.
Can people hear me from the back? No.
Here.
Thank you. Well, there is one rule where, in the proposed regulation, where the intermediary has to have a reasonable basis that the issuer is in compliance with all of the requirements under Regulation Crowdfunding that apply to it. So I think that's a perfect example of where the intermediary would have to know whether or not the issuer can actually rely on this exemption.
Karen.
Oh, sorry.
Yeah, and can you guys hear me?
Yeah.
Yeah. So, as an aside to that, the statutory bar on an investment company also applies to any, any exemptions to the, 3C1 or 3C7. So that also means that you cannot have a holding company to hold all your crowdfunders. So they will all have to be directly on your cap table. And, from a practical perspective, that's one of our. From a practical perspective, that's one of the really big issues that we're trying to solve is this. How do you deal with 1,000 or more shareholders on your cap table when you can't have a holding company?
I think as an industry, a lot of the crowdfunding sites, including Seed Invest that Karen's involved with, in order to satisfy the reasonable basis, they're getting reps and warranties from the people who are posting to their sites in anticipation of the offering. So you have to ask those questions proactively in order to have a reasonable basis and satisfy that test. Another example that I get asked a lot is if it's only domestic companies and domestic companies want to drop a sub so they can give the money back to their European operations, that's not consistent with the intent of the statute. So we have recommended against that for all of our crowdfunding sites.
The bottom line is that although jobs stands for jump our business startups, it doesn't necessarily stand for generating jobs. The object of the exercise was to create capital formation in the United States. And that's going to be a significant component of a lot of the comments.
And just furthering what Doug was just speaking about, we just received a question in about, if a issuer uses a U.S. entity to raise funds, but it, distributes that money, those proceeds to an offshore parent, would it still be in compliance with the regulation? And I think what we were pointing out is that the per se rules, it would be, but it's obviously not the spirit of what the regulation was intending.
On that score, how much do you import other things that the SEC has said for the last 50 years? For example, in the old days, if I set up a company and I said this company is going to lend all its money to its parent, and I wanted to file a registration statement for that company, I got to tell people what the financials of the parent are, right? So if you apply that by analogy, if I'm going to try to use Reg CF to raise money for a company that's nominally a U.S. company, but its only asset is going to be a loan to its parent company, or it's going to take all its money and distribute it to the parent company, then I'd say it obviously falls foul of what's going on here.
The question is, what happens if you have a variation on a shell company subsidiary that is doing the crowdfunding offering? How much disclosure information you have to provide? I think we'll wait for Doug to talk about that question, but recognize the theory here is, and whether you believe in the theory or not is up to you, that crowdfunding will develop a conversation among potential investors to discuss the advisability of a particular investment. This is the crowd, and that the crowd will talk about it, and the crowd will post messages on the internet portal to discuss it. And the crowd will make a judgment as to the merits of the offering. Whether you believe that or not, that's a different story. I think
this is probably a good time to shift to Doug.
It's a good segue.
Okay, great. And thank you for the invitation to speak today. I appreciate it. I'm not going to go in great detail with what the disclosure requirements of the issuer are in front of a bunch of lawyers who have seen securities documents. What I am going to highlight for you, contrary to a lot of public sentiment and misinformation, in Title III, unlike Title II, where there is no statutory requirement of disclosure except to satisfy anti-fraud standards, Title III has a laundry list in the title, as further expanded upon in the proposed rules slightly, not significantly. A lot of people like to think that it make more of it than it is, and the staff did add a couple of features to the proposed rules. But for securities lawyers, it's quite consistent with what you would find in any index of a private placement memorandum or a prospectus of things that you would want people to know what the opportunity is, who the people involved are, what are the risks associated with the transaction, what are the securities being offered, what's the valuation, what's the price. All those sorts of things are statutorily required and included in the proposed rules. What's interesting about the proposed rules is that the staff took a very in my view, enlightened position that how that information is communicated to the investment community in the crowdfunding platform ecosystem is flexible. It doesn't necessarily have to be done pursuant to a private placement memorandum. It could be contemplated that it's done pursuant to a video presentation only. The requirement is that you hit all of the ingredients that are in the statute and whatever happens with the proposed rules. And more importantly, make sure, unlike in our exempt markets today, that the investors have a true understanding and appreciation for that information. A colleague of mine who's often on the crowdfunding tour, and one of their colleagues is here today from CrowdCheck, calls it digestible information. I love that term, as opposed to substantive technocratic information that I pump out of my firm every single day that nobody reads and probably doesn't even understand. This is supposed to be in a format that people can actually appreciate and understand. And when we've spoken to corporation finance as it relates to some of this, their repeated refrain often is, you have to make sure that they understand it, whether it's through hyperlinks to technical terms that have language, what's a convertible preferred stock, and make sure you really take them through a process that they can actually appreciate and understand the technical terms so they know what they're investing in at the end of the day. And the other thing that's coupled with that, again, it doesn't show up in our securities practice typically, is an education requirement. Again, the staff in the proposed rules chose not to put forth a set of requirements as to what the education requirement are, and you have to check the box in order to satisfy that standard. It's supposed to be comprehensive. You're supposed to make sure that when, back to Jay's 91-year-old mother, invests, you have a database of information, because a crowdfunding platform is a technology solution that has a server associated with it, that when and if Jay's grandmother loses her money and complains about it, and the state now can get involved, or FINRA can get involved, or the SEC, that you can go back to the videotape, the history of the transaction from the time they enter the crowdfunding environment until they push the button to invest, and demonstrate that you satisfied the statutory requirements as well as whatever ends up from the proposed rules. And as a securities lawyer, often in front of professionals like yourselves who look at me like, why would you associate yourself with crowdfunding? I am very comfortable in saying that if crowdfunding sites like Seed Invest do what they're supposed to do, that the investor for the first time is actually going to be held to an account for the information that they are presented. And when they try and suggest that they've been defrauded in some manner, it's unlikely, because FINRA will have already vetted that architecture and know before the securities are sold what process the individual has to go through before they can push the button and invest. And I'll give you an example. When we were with the commissioners in one particular meeting, and the details matter here. So when you're out talking to people about why you hate crowdfunding, well, some of you hopefully will convert, it's important that you understand that before somebody can push a button to invest, that you can engineer the technology, and maybe Kieran will add some details to this, that if they haven't read the risk factors, or they haven't spent enough time looking at the risk factors, that when they push the button to invest, because they skipped that part of the site, it's going to come up and say, no, you can't. You haven't read the risk factors. You need to go back. Or you spent less than 30 seconds looking at the risk factors. Go spend more time. Answer this survey of questions. Every site is going to do it differently. The SEC didn't dictate or mandate how it has to be done, but it's got to be done with full education of the individuals before they invest. So that's what I would suggest on disclosure. Their financial statement requirements, again, and I like to compare versus other programs. Title II, which we're not here to talk about, doesn't require audited financials of any kind. I understand it's accredited investors. That doesn't make them sophisticated. But that's not what the statute requires there. Title III says up to $100,000, the only thing that has to happen is that the financials have to be certified by the management team. They have to be in GAAP compliance as well, which is forgotten by many. Then between $100,000 and up to $499,000, they have to be reviewed by an accounting firm that doesn't have to be PCAOB. And above $500,000, it has to be audited. And again, still in conformity with GAAP. There's a lot of comment letters as it relates to whether or not that $500,000 is going to be increased. The staff had a lot of those comments prior to October 23rd when the proposed rules came out. They elected to stick with what is in the statute, and from my point of view, I don't think that that's changing anytime soon. As it relates to the continuing reporting after the financing, the only thing that the rules require is that there's an annual reporting of the entrepreneur. And then the financials have to be consistent with what was done in the original financing. So if it was audited, then it has to be audited again. And there's a lot of controversy about the ongoing costs associated with that continuing audit requirement. What's interesting, and I think for those of you who are professionals in the room who work in the corporate finance space, and we're in New York, and we all know a lot of the accounting firms in town and what they charge for auditing, a lot of people say, okay, economically not feasible. Don't dismiss this as based on your personal professional experiences. I am telling you, across this country, there are professionals and technologists who are coming up with new ways of doing things, who are willing to do them less expensively than maybe here in New York. And there will be an economically viable way of doing this going forward. I've heard numbers from many different corners of the country of $5,000. You may question the quality of that work. I'm not here to tell you because I haven't seen it, but it is a number that's often being used. And so it's worth taking note. And Ryan Fite, who's the owner of Seed Invest, has a tweet out about the costs, and I'm sure Karen will go into the ongoing reporting costs associated with doing a crowdfunding campaign. There are also people going to do a $499,000 raise coupled with the side-by-sides, which are 506B or C offerings, and raise much more money and stay below the audit requirement. Assuming that in the side-by-side deals, and we'll talk about integration in a minute, that you can actually do both those exempt offerings in a way that's respectful of each of the exemptions separately. Okay, and the annual information has to be submitted to the SEC, posted to the issuer's website, but does not have to be mailed. And it's another example in my personal judgment where the SEC, and my hat's off to Layla, the trading and markets folks, and the corporation finance folks who've worked really hard on this for 18 months with us. There were lots of opportunity within the proposed rules where they could have imposed traditional established ways of doing things, would have made this program much less economically viable than it is. I think they took a very enlightened approach to the whole program. It isn't to say we don't have disagreements, however, and Layla knows them. The next thing I want to point out practically is that portals, each portal is going to have a different approach to whether or not they have ongoing current and periodic reporting, like the call it the publicification or the publicness of the exempt world, where they're going to require issuers who raise money on their sites to, on a monthly, quarterly basis, provide ongoing information as if they were a public company. I think that's really enlightened. As a individual investor who often never hears from the entrepreneur again after I've given them money, I find it offensive. I encourage our crowdfunding portals in their portal agreements to consider the possibility of having Google Hangouts on a quarterly basis where the management team has to communicate with their investors on a go-forward basis, notwithstanding the only requirement in the statute is annual, as I said before. And Karen presumably will also share what they're doing on their site. I don't know how much time, if I'm going too slowly.
No, you're going fine.
Okay. I was given a lot of information to make sure you all got.
Section to get through.
Before you go
Let's
on,
stop.
on what you just said, the annual financials have to be submitted to the SEC.
Yes.
Are they going to be on, the immediate question is, are they going to be on Edgar?
Well, yeah, I think for the issuers, the issuer reporting will be through Edgar, and
But-
the proposal.
They're not going to have to do XBRL filings, are they? Please no, because that's going to triple the cost.
Can I,
Well,
you want me to jump in for you?
Yeah.
So there's a lot of conversation on how the information is going to be submitted or filed, along with all the presentation materials. The SEC is taking a pretty expansive point of view that not only the annual, but the offering materials, no matter what format they're in, have to be filed with the SEC. And there's some real technological
Like a video.
problems with how you do
tricky.
that. So I think those are going to be fleshed out much more carefully in the commenting period, and there's a lot of pushback on some of that information. The other thing I did want to note, because it's a pet issue of mine, and I'm sure nobody in the audience is concerned about fraud, but my bigger concern is use of proceeds and how you track use of proceeds and use of proceeds compliance. From my point of view, as a securities lawyer for over 20 years, the bigger problem I see is not people trying to defraud the public. It's not to say that it doesn't happen. That's why the SEC and the states have a role to play in this. But the compliance with raising the money and spending the money the way you said you were going to spend the money is critical to us. And the portals, in my judgment, have a role to play here where they can educate the entrepreneur as to those responsibilities. It's not required in the statute. It's actually a big miss in my judgment. These are young entrepreneurs in many cases, and they don't understand the sensitivity of raising money from people that they don't necessarily know. Doesn't mean they don't know them. I think practically more often than not, the entrepreneur is going to know much of the community of the people who are putting up the money. You can have certifications that require the entrepreneur to attest that they understand that sensitivity, like a Sarbanes-Oxley sort of certification. And then there are technology solutions that are being advanced as we speak that portals are going to work with to monitor the ongoing use of proceeds after the financing. And if we actually accomplish that, it's going to be much better than what's done in the exempt world today, where even venture capitalists, I don't believe, have a true sense as to whether or not the money was spent the way it was supposed to. So that's one of my pet issues, and so I put it out there. There's a question out there.
I know that the registration scheme for a portal is not as extensive as it is, say, for a broker-dealer, but might the statute someday get in the direction of having some sort of on-site verification of use of proceeds from the settlement company to the company?
Okay.
I think the question is that a well, first of all, broker-dealers are much more tightly regulated than a crowdfunding platform will have to be, even though they will be monitored and regulated by potentially, more than likely, FINRA. And the question, I think, is, well, I guess I'd ask you the question, what do you think a broker-dealer's ongoing responsibility post-financing to monitor the use of proceeds is? You made a statement as if there was a, and I'm not sure I buy the conclusion.
Or none.
It's in the placement agency agreement that the entrepreneur has to spend the money the way it's supposed to be. As it relates to post-financing ongoing obligation of broker deal, I'm not so sure about, truthfully.
If the question that was posed was whether or not we're moving towards an obligation by the portal or anybody else to verify use of proceeds, and my question to you is, so why is this any different from what happens right now with an S1 registration statement? You file your registration statement, you take the money, and yes, a year later, or a quarter later, when you file your next Q, you've got to show your statement of cash flows where your money went, and then annually you got to show. But nobody other than the analysts monitor it.
So
should you impose a tougher obligation on a crowdfunded company?
I think the industry's point of view up till now has been your observation's spot on. We don't disagree with it, and the statute doesn't require it. However, if we as an industry can come up with a technologically based solution for better compliance to get rid of a potential problem that could be a blemish on the industry and do it better than it's being done in the exempt markets and public markets than it's being done currently, then it's a great thing because it is a technology-based solution and we can do things that have not been thought about previously.
There are two differences on that, and I'm not a big fan of extra work and extra regulation, but there are two differences. One is that embedded within the legal requirements for the whole use of CF is you can't have certain kind of companies. You can't have investment companies. So there is a point to monitoring to make sure that it didn't violate that. And also, you're not necessarily demanding the same level of sophistication of the investors when you do a CF deal. And therefore, you can't rely on, whether this is realistic in other offerings, you can't rely on the proposition that these guys are careful, they're putting in a lot of money, so they're going to monitor it themselves. So maybe there is a reason to require monitoring.
Well, there's a commercial reason, and I'll let Kieran speak to it. If you're a crowdfunding platform, you want your audience to have a good experience and not have a problem because they're not going to do business in your marketplace afterwards. So this is a commercial solution to a real problem as opposed to the fake portal that goes up. Yeah, and I'm glad the statute doesn't require it, but this is a way commercially of responding to a more realistic problem in my mind.
Yeah, so I mean, before we go too far and come up with a portal obligation to monitor use of proceeds, I just want to note that I think the use of proceeds disclosure should be accurate when it's made. We all need to understand that startup companies change business models from week to week. I've been at Seed Invest for 6 months, and we've probably analyzed 20 different business models, and that's just the nature of what it is. So for people for some third party to be coming around and monitoring what me as a startup entrepreneur is spending my money on months after my offering, I don't know that that's a good idea. I think the disclosure should be accurate when it's made, and at Seed Invest we have a lot of tools so that investors can keep up with what's going on in the company, including a virtual boardroom where the CEO comes on and does a live webcast with the investors. The ability to ask questions over time on the platform. So I think there are other ways to do this without sort of creating another regulatory obligation that may just add another layer of red tape to what an entrepreneur already has to deal with.
Okay, so I'll move on.
Wait, we gotta.
Oh, sorry. Hey, Rich.
Point. I would have a concern that creating an issue of liability and responsibility for the funding for where the broker-dealer, for whichever it is, to now take on an oversight role which really can't enforce employers.
Okay.
Well, that's
We might put a
that's
pin
Karen's
in that
point of
one.
view.
Yeah.
Right.
We might put a pin in that actually for
Yeah,
when we move
fine.
to
Right.
the portal discussion, because that's a really good point.
Right, because I'm sure Layla and the SEC are of the view that the crowdfunding platforms shouldn't have that responsibility either.
And
Okay.
she'd be right.
Again, we made the distinction between what's required and what may be a good commercial practice to be considered. Transfer of securities. So under the rules, the statute and the rules, it's a 1-year holding period. There's some oddities within the way the rules constructed for real technical securities lawyers about things that can happen prior to the 1 year, transferring the shares to accredited investors, and some implications there. But the basic concept is the shares can't be transferred for 1 year. And then the question is what happens after that 1 year hold period. And the point that needs to be made is that crowdfunding platform is not licensed, for lack of a better word, to do secondary market trading. You have to be either a broker-dealer that's authorized to do that or what's called an alternative trading system in order to facilitate that marketplace after the original issuance in the original financing. And so while there will be platforms that are set up to be ATSs, and some of you may have heard of firms like Second Market and SharesPost, which probably won't be in this business, there may very well end up being an active business in the secondary market placement of these or transfer of these securities after the 1 year holding period. Because these are not 12G companies, there's no mandated transfer agents for tracking, although in the proposed rules, they go to great lengths, the staff, to make it clear that there's a responsibility to make sure that the issuers have good bookkeeping and record keeping, which is touching in and around the reality that these companies don't have to have transfer agents, and what happens after that 1 year period, which is a real concern to the regulators, and it's one that I think the crowdfunding platforms have to take very seriously. The proposed rules, as well as the proposed rules, make it clear that the original financing is an exempt transaction, and that it won't trigger 34 Act reporting. And in the proposed rules, the SEC, again here, took a very enlightened point of view from my point of view that it's permanently exempt even on the subsequent transfers, that you don't trigger 34 Act reporting through those secondary transfers. Solicitation. So the way crowdfunding platforms work, again, and I'm not talking about broker-dealers, you want me to move it along? Sorry, I just want to be respectful.
No, not at all.
Okay, so crowdfunding platforms, pursuant to the statute, it suggested that they could put out they could tell the world online what they're doing, and that they're looking to raise money for entrepreneurs in a Title III crowdfunding environment. They could not talk about the individual deals that were happening on their sites, because that would be that's just not the way the statute was constructed. The entrepreneur could talk about looking to raise money, and that was about pretty much it, and then go refer the audience to the crowdfunding platform so that they could then register and then see all the information in that ecosystem. The proposed rules, again, I think took a slightly different point of view than the statute, a more expansive point of view, which I actually think is very commercially oriented, allowing the entrepreneurs to indicate both the terms of the offering and what the securities are, not just limiting, hi, my name's Doug Elenoff, I'm looking to raise money on Kieran's crowdfunding site, and that's the end of it. You're allowed to talk about what the business is, and so I think that helps facilitate everybody going to the crowdfunding platform. So that's what you're allowed to do under the notification requirements in Title III. And that's going to be very important when we get to the next section on integration with side-by-side deals. So you can do slightly more than what's in the statute, and I would encourage people to read the proposed rules to see what you're allowed specifically to say. But you have to be careful. You can't go too far even in that regard. The other area generally around solicitation, and we've talked at length about it with the SEC, the crowdfunding site can buy emails and get people to come to the crowdfunding platform in order to look at deals on their site. What they cannot do, you can't pay finder's fees, and you can't pay for, and I always get the term wrong, so I'll say that in advance, PII, personally identifiable information. That's the really sensitive term of art that you have to really bear down when you're reading the proposed rules. A crowdfunding platform may not pay and get PII, and nor may the entrepreneur for that matter as well. Okay, final issue for me is integration. So here's an area again where I think the staff took a position that helps facilitate side-by-side deals. They are careful not to say, well, just go do a Title III and Title II deal at the same time. They're not saying that. They're saying you have to comply with both different exemptions in order to avail yourself of doing a side-by-side. And what I think that practically means is that if you want to do a Title II general solicitation, you have to limit the notification that you're giving to the world to make sure it's consistent with the same information that's otherwise recommended as proposed in the Title III environment. There are other areas that you have to pay that are sensitive that you have to pay attention to, but they are saying there is a pathway forward where they can contemplate you're doing a side-by-side arrangement, but you have to be respectful of both exemptions at the same time. And that's I want to invert it. For those of you who are doing Title II deals, you also have to pay attention. This is not Title III related. Be very respectful of the differences between 506B and 506C. It's different state by state. It's different. It's interpreted different at the SEC. And so if you think you're doing a 506B and your issuer is tweeting about it, you're probably in 506C land. So be very careful. It's a real hot issue that you have to spend a lot more time on. Thank you.
Okay.
We've got a few minutes for questions on this one.
Yep, and we got one web question, and stepping back a little bit, but as far as the ongoing reporting requirements of issuers, when is an issuer allowed to stop with the continued annual reporting?
It's in the proposed rules, and truthfully, Layla will probably, or Karen will remember.
Yeah, so I believe it's when you've retired all of the crowdfunded securities, so they're no longer outstanding, or the company dissolves, or you become a public reporting company.
Yeah.
Yeah, there's one interesting question with respect to the permanent exemption from 12G. Do you have to have paper certificates that are blue and red? So what happens if I own some securities of the company and then I get some other securities that I buy on the secondary market that were issued in a crowdfunding and then I resell them? Which ones am I buying? Which ones am I selling? Or more, actually, it's more importantly, which ones am I selling? And we're all going to...
From a 12G perspective, it's really the issuer that's going to be, once the issuer knows how many Reg CF securities it's issued and it knows how many non-Reg CF securities it's issued. So when it's doing its calculation as to what reporting requirements it has, it's going to know how many holders of record it has.
If I'm a holder of non-exempt securities and I buy some exempt securities and then I sell some but not all of my securities, am I selling the exempt securities or the non-exempt securities? And I think the answer is another, like what I said about not watching legislation being made.
Well, I think this goes to the staff's concern about keeping books and records.
Yeah, it's tough.
And there are a lot of transfer agents who are considering getting into the space, and they're dematerializing the certification process. So it'll just be a computer entry system. When we were down at the SEC last time, there was somebody who was a transfer agent, and he said all those things, if you have to have the transfer agent from the beginning. Yeah. It's only when you start piecemealing it together, I think people are going to be able to play. Those record-keeping issues will become a problem. But if you good discipline has it, if you start at the beginning with a transfer agent-like record-keeping system, you'll be okay.
But do you advise your client not to become DTC eligible?
What you're getting at is the next stage when we come back next year to talk about
Okay.
how these companies really become public. And the quick summary, and then I'm really going to move on, is while I think there's going to be a the high end of Title III may go public through the pink sheets or the equivalent. I think the vast majority of these companies, and it's a whole philosophy I have, which maybe everybody else disagrees, are community-based financings by friends and family. They're going to be debt financings. They're not really going to be securities. You'll have some high-end tech app deals, but I think it's going to be the outlier. I don't think it's going to be primarily what the industry is.
Okay. I think maybe this one question, because he's been raising his hand for quite a while, and then we've got to move on to Layla.
Side-by-side door, you're doing like a straight regular private placement, and then you're also doing crowdfunding. If in your like private placement disclosure on the crowdfunding raise, you give some disclosure about, as part of the material disclosure, the other private placement you're doing. Is that going to screw up that? Make that into a general solicitation?
Repeat it.
So the question is, if you're trying to do a side-by-side financing with a Title III crowdfunding, and then you have to make the distinction between a 506B traditional private placement and a 506C. And I think you're referring to a 506B where it's a silently, quietly off, privately placed security to people you have a pre-existing and substantial relationship with, which is the buzz phrase. In the footnotes to the proposed rules, it's touched upon, and it acknowledges that you could theoretically complete both a Title III and a 506B offering, but it's highly sensitive for the reason you just pointed out. Title III, by definition, is a quasi-publicly marketed security. So I think you better be able to establish by facts that you really have a substantial and pre-existing relationship with those investors well before you embarked on your Title III campaign. Sound about right?
Yeah.
Sounds
I'm
good.
getting a yes.
Okay.
Layla?
Oh, sorry, Layla.
Yeah, sure. Thanks. Okay. Great. Hi, everyone. Thank you all for coming, and thank you to the New York State Bar Association for having me here. Before I start, I have to read a standard disclaimer. Bear with me. The views I express today are my own and do not necessarily reflect the views of the Commission, any of the commissioners, or any of my colleagues and the staff of the Commission. Okay. So, as Jay mentioned, I'll be talking about the intermediary requirements in greater detail. But before I do that, I do just want to note that in general, the proposed rules really adhere very closely to Title III. Title III had a lot of mandatory elements, and there are really just a handful of places where the Commission exercises discretion, and I'll try to highlight some of those for you today. And also, as Doug highlighted, the Commission went out and solicited public comment before issuing the rule proposal, which is something it doesn't always do, but it was very helpful for the staff in drafting the rules, and we certainly tried to do that in a way that would allow this new market to thrive by balancing the need to facilitate capital formation for these types of issuers while protecting investors. So we look forward to the comments people may submit through the end of our comment period. As you all know, Title III provides an exemption from registration. So along with an exemption, there are certain conditions. And one of those conditions is that the transaction has to take place through a regulated intermediary that, as we've said before, is either a registered broker or a registered funding portal. And this has both legal and practical implications. So first, as a regulated intermediary, as a regulated entity, the intermediary would be subject to rules, examination, and oversight, of course, but it also means that a transaction pursuant to Section 4A6 is happening in one place, and that is on the platform of the intermediary. So all the investors will go there to see the issuer disclosure materials. That's where the crowd is going to discuss the offering and also discuss their views with representatives of the issuer. And finally, if they decide to purchase the security, it's on that platform that they will actually make that purchase. And when you think about what crowdfunding fundamentally is, right, it's an online offering to an unlimited number of largely retail investors. So the role of the intermediary here is really as a gatekeeper between small and startup companies on the one hand, who are relatively unsophisticated in this market, and on the other hand, a large number of retail investors. So who are the intermediaries and what exactly is a funding portal? We're all familiar with brokers. There's an existing regulatory regime for them. But funding portals were specifically created in Title III of the Jobs Act. What they are is a limited purpose broker that engages only in crowdfunding offerings. So as a technicality, they're brokers that the SEC conditionally exempts from the requirement to register as broker-dealers. However, they would have to register with us as funding portals. The statute itself restricts the activities of funding portals as compared to brokers, and I'll run through those restrictions now. So first, unlike brokers, funding portals cannot give any investment advice or make recommendations. They cannot solicit people to buy the securities offered on their site or pay others to do that. And finally, they cannot hold, manage, possess, or otherwise handle customer funds or securities. So as you can imagine, in light of all of these statutory prohibitions, we did receive a lot of comment from people asking us, well, how are we supposed to carry out our business as a funding portal if we can't do all these things? For example, if we highlight a particular offering on our website, is that considered investment advice? So in response to this, the Commission proposed a conditional safe harbor to give funding portals assurance that certain activities, if they're carried out in accordance with those conditions, would be considered consistent with the statutory prohibitions. There are many elements to the safe harbor. I'll just run through a couple of them. One of them allows funding portals to limit the scope of their business. So for example, if they want to specialize or create a niche for themselves, maybe they just want to deal with offerings for issuers based in the Detroit city, for example, area, they could do that. There just has to be an objective criteria for what they're doing. They also can highlight certain offerings on their website. Again, it's based on objective criteria. I'll quickly run through or highlight some of the requirements on intermediaries. And this applies regardless of whether the intermediary is a broker or a funding portal. So first, every intermediary has to register with us, with the SEC, and they also have to become a member of a registered National Securities Association. Today, there's only one National Securities Association that's registered under Section 15 Cap A of the Exchange Act, and that is FINRA, or the Financial Industry Regulatory Authority. And at the end, I'll talk a bit about FINRA's rules in this space. There's a prohibition on intermediaries as well as on their officers, directors, and partners from having any financial interest in an issuer whose securities are being offered on their platform. And of course, this is to prevent conflicts of interest and high-pressure sales tactics. And there's also requirements aimed to reduce the risk of fraud. And the proposed rules address this statutory requirement in three ways, which I'll go through now. First, an intermediary is required to have a reasonable basis for believing that the issuer is in compliance with the crowdfunding requirements that apply to it. This is what somebody had asked about before. And in doing so, the intermediary can reasonably rely on representations by the issuer. And the whole idea here is, the intermediaries will be in contact with the issuer and should be familiar with their business and have a basis to assess the representations they make in this regard. Second, which is something Doug mentioned, the intermediary has to have a reasonable basis to believe that the issuer has established means to keep accurate records of the holders of the securities it offers through its platform. As he mentioned, the statute was silent on this point, excuse me. And so this is, of course, one area where the Commission exercises discretion to raise this point to not necessarily require the use of transfer agents, but request comment and put this requirement on the intermediary. And the third measure to reduce the risk of fraud is the requirement for intermediaries to deny access to their platform if the intermediary believes that the issuer or offering presents potential for fraud or otherwise raises concerns about investor protection. There's been a bit of comment since our proposed rules came out about funding portals not being able to curate, in other words, not being able to pick and choose the specific issuers that are on their site. But I do feel that this particular requirement, along with some of the elements of the safe harbor, give funding portals a good degree of flexibility in terms of who they have on their platforms. The proposed rules also have requirements for intermediaries regarding operations of the platforms during an offering, and I'll run through some of those. So first of all, there's the educational materials, which Doug alluded to, and he's absolutely right. The Commission specified some of the content that needs to be in those materials, but it did not specify the form that it should take, so we've left that fairly flexible and open for comment. Also, before intermediaries can accept any investment commitment, they need to have a reasonable basis for believing that an investor satisfies the investment limitations set forth in the statute. So these are the limits that Jay first talked about based on annual income and net worth. And this has also gotten a little bit confused with the concept of investor verification, which is really a Title II concept. So it's true, in 506C, the final rules include an obligation for an issuer to take steps to verify purchasers' accredited investor status. But under Title III, there is no specific verification requirement. What there is just a requirement that intermediaries take steps to ensure that investors have not passed their individual thresholds. And how the proposed rules address this is really through a reasonable belief standard. So for example, and also if you're looking at the rule proposal, you may not see it in the rule text itself, but I encourage you to look at the front end discussion of that particular rule. So for example, an intermediary could prompt somebody when they're on the site, and before they click to make an investment, they could be prompted to provide their annual income or net worth, provide the accounts where that person has, the platforms where that person also has accounts outside of that particular intermediary, and also the amounts that the person has already invested on those other sites over the past 12 months. Furthermore, the intermediary is going to be charged with the knowledge of what other investments that particular person has already made on its site in the past 12 months for other issuers, for example. And in addition, the issuer itself is charged with the knowledge of other investments that person may have made in the same issuer through crowdfunding transactions in the past 12 months. So when you put these pieces together, that investor representation can help an intermediary to form a reasonable basis as to whether or not a particular person is actually within his or her investment limits.
Quick question.
Yes, sir.
About the the investor limits. I just want to make sure I understand from your earlier discussion also. The $2,000 or the percentage limit based on your income or net worth, that I thought that had applied for all investments that an investor would make in all crowdfunding issuers over the course of the year, not each individual issuer. Is that correct?
Yes, it's correct. So the question was, do the investment limitations apply for all crowdfunding transactions within a 12-month period, regardless of which issuer? And the answer is yes. So you basically have to look at every investment a person has made across all crowdfunding platforms and any issuer relying on that exemption.
Right, so you can't make 2,000 in company A, the same year 2,000 in company B.
Yes, well, you can, but you have to be within the limit. So you aggregate.
But you can,
Within the
hold it.
$100,000 limit. That's-
Yeah, the absolute cap is 100,000. Right.
Wait. Suppose I have a guy homeless on the street, but somehow he comes across $1 million. Can he invest $2,000 in 500 different companies so he gets up to his $1 million?
I think so.
No, it's $100,000 12-month hard cap for anybody
Yes.
accredited or undercredited, period.
On all issuers,
Yeah.
not per issuer.
The per issuer cap is the 5 or 10%. That's the per issuer.
How in the world can you possibly
I thought the
regulate
number-
what any
yeah.
individual
We're not-
invest?
That you're getting back to the
That's just
reasonable
where we-
basis standard for understanding what they're doing. But the hard cap is $100,000 in 12 months from any individual or entity in
In any issue.
In one issuer or in all issuers?
all issuers in crowdfunding in a
In
12-month rolling
Regulation
period.
CF.
It doesn't say that.
That can't be the rule.
It doesn't say that. It says, I mean, we're going to have some fun here as lawyers, but 227-100A2 starts with the aggregate amount of securities sold to any investor by any issuer.
Any.
And sub 2 is where the $100,000 limit comes in. I read this, and I read the statute, which unfortunately I left on my desk, to say that the $100,000 limit is modifies the sold to any investor by any issuer. Because if you think about it, it is impossible to monitor other than to take an affidavit from the purchaser how many times he bought crowdfunding deals.
Except that, I'll just make, and I haven't burdened, I am unburdened by having actually looked at the rules.
Better off than the rest of us.
But Georgia worked with me, and therefore I know that she has. But I think, I could be completely wrong, I doubt the public policy behind the statute in this regard was to allow people who have presumably limited net worth to spend a lot of their money on 3,000 different crowdfunding investments.
Yeah, the comment is that.
Why Doug, I think, responded the way he did, but clearly from what you read in the proposed rule, it may not read that.
The comment for those on the webcast is that public policy probably did. If you can say that public policy has an intention, but public policy did not intend, or Congress in implementing public policy did not intend to allow people to put individual people to put massive amounts of money into a crowdfunding transactions. That's probably true if you read the statute as a whole. Frankly, I don't think that Congress thought about non-natural persons investing in crowdfunding when you read the word choice. But I think that that's what it says. Now, that may be an appropriate area for comment, but I don't know how Kieran, because an issuer can only use one portal, and presumably the reason why that rule exists is so that the portal can then monitor compliance. But 5 issuers can use 5 portals.
But we have a threshold question, since we have some disagreement on the panel, to what the proposed rule says, putting aside whether it should be structured a certain way to ease compliance by a portal or intermediary. The question is how it's going to end up.
So just to clear it up, the statute is a little deceptive. And from an issuer perspective, they have to make sure that there's not more than 2,000 for themselves. But as a portal, we have to make sure that they have not put in more than 2,000 across all issuers. So it actually does apply aggregately over all issuers. And this is actually one of the biggest concerns we had before the regs came out, in that we were going to have to go check what people were doing on other portals. The staff, I think, got this one right in allowing portals to sort of rely on the certifications of the investor, combined with sort of a reasonable belief standard to allow this could have simply made it too difficult for a portal to operate. So I agree with Layla. I think it's across all issuers.
Yeah, and just to clarify, the proposed rules do contemplate that it is across all issuers.
Do you have the language of that?
So it's in.
Let me see. I'll see if I can do that.
I'll just carry on. So I was going through the the intermediary requirements. I'll run through a few others. Of course, there's a requirement that the intermediary has to make publicly available the issuer disclosure materials. And they also need to have communication channels on their platform. The idea is that the communication channels are publicly viewable, but in order to post a comment in the channels, you would have to open an account with the intermediary, and this is just to provide some accountability to comments made. And furthermore, anyone who is a promoter of the issuer would have to identify themselves as such every time they post a comment in those channels. There are also other requirements about notices, when notices have to go out at certain points during a transaction, confirmations, and they also have to give investors a chance to cancel investment commitments anytime up to 48 hours before the deadline to meet the target offering amount. So now I'll run through the requirements that apply to funding portals, only funding portals. So one of the funding portal requirements is that they have to maintain a fidelity bond coverage of at least $100,000. This is also consistent with the FINRA rules and is another area where the Commission exercises discretion. And this was in light of the fact that funding portals are not covered by SIPC. Funding portals also would have to have written policies and procedures and comply with other requirements that brokers are already required to comply with, such as Regulation SP for privacy, Reg SAM, Reg SID, and also the AML provisions of the Bank Secrecy Act. And finally, funding portals are subject to a more streamlined version of the broker-dealer record-keeping rule. Again, it's simplified compared to the broker-dealer record-keeping rule. And finally, I'll just talk very quickly about the FINRA rules. So as I mentioned before, funding portals have to become a member of a registered National Securities Association, that is FINRA. The Jobs Act went further actually to specify that that National Securities Association must write rules specifically for its funding portal members. So on the same day that the SEC proposed rules under Title III of the Jobs Act, FINRA came out with its own draft rules for proposed rules for its funding portal members, and you can find this in Regulatory Notice 13-34. And so basically, FINRA's and the SEC's comment periods are now running concurrently, with the aim that once we have final rules and they go effective, that can happen at or around the same time. And if you have a look at the rules, I think you'll get the sense that just like ours, they've really taken a streamlined approach to the rules they already have for their broker-dealer members in light of the fact that funding portals just have a much more limited scope of activity. So I think I'll open it up for questions.
Okay, well, we have some from our internet viewers. First of all, do portals have any diligence benefits from, as would an underwriter in a registered offering, verifying the accuracy and completeness of disclosures that the issuer provides? So I think this is something like the due diligence defense sort of concept. How do you see that playing out with portals?
I think Kieran might be talking a bit more in detail about the liability aspect, but I mean, yes, as a practical matter, there are certain steps all intermediaries have to take to know who the issuer is, know that they're in compliance. And there's 10b-5 liability, there's also statutory liability. But I will note that the statutory liability provision in the Jobs Act does include a due diligence defense in it. So if you've taken reasonable care, and in the exercise of that reasonable care couldn't have known of a certain misstatement or omission, then you're not liable. And I believe that's just straight from the statute.
Yeah, we've got another question. I think this is probably really for Doug. It looks like it came in from somebody at a portal. It reads, "We intend to hold public events when issuer would explain its investment offering to potential investors in person who could invest online later. Is this not permitted?" Yeah, the traditional roadshow.
What an issuer can, people are often confusing Title II and Title III, but I think this is a specific Title III question.
Yeah, this is a Title III question.
You can't say more than the notice provisions that are articulated in the proposed rules, which is limited to, this is who I am, this is what we're going to do, the terms, the securities, go visit such and such a website. As Layla said, the rules require that all of the real meaningful business be conducted on the crowdfunding platform. So you could certainly, as an issuer, tell people this is, you could go to a demo day or a conference and say, I would like you to go visit a website, but you can't go into any great detail beyond what's statutorily permitted and the proposed rules articulate that you can say. So you have to really limit your communications.
So therefore, road shows are out.
Unless you want to say 5 things during your
real road.
Practically, that's correct. Again, I want to then, because
an
I think
online road show.
Yeah, can't you have a webinar and people?
No. All the communications, the staff wants the ability, as do state regulators, to audit what transpired. The only way they can do it if it's done completely on one database or central server through a crowdfunding platform. And that means no free writing prospectus sort of disclosure that's going on outside that ecosystem.
See, this is the whole idea of the crowd. They want no imbalance of information. They want all of the information out there, open and easily accessible and easily understandable in plain language so that everybody can see it Everybody can look at it, people can talk about it and make judgments as to whether an investment is suitable.
Right, but let's think about that scenario again, from a technological standpoint. What about having a webcast housed on the funding portal where the issuer and potential investors that have signed up to participate on the portal are having a discussion or having a dialogue? What's the difference with it being, in a video base versus having the online chat board?
Well, Blake, you're right. She's a sharp one. She's a keeper.
There's what she's-
Obviously.
Where there's a problem, there's a solution. That's the solution. But it's not directly responsive to the question. It's the right lawyer answer, which is here's a better way of doing and what's permissible. So yes, anything that's being conducted on the crowdfunding platform that the entire audience can see, that's appropriate.
Doug, I want to just quickly come back to one thing, and I know we're running short, so I'll try and be brief. So suppose somebody comes into a transaction, it's a Title III, it's what we're talking about here, and they sign up, and everything's done correctly. But it turns out that this individual happens to be an accredited investor, and they wish to exceed the limit, whether it's per deal or the aggregate as we made, or we put that aside. And someone says, okay, we're gonna do make up a little one investor 506C transaction, and guess what? All of a sudden it's 105,000 rather than 100,000. Now I know that the SEC is trying to accommodate all of this and to avoid some of the Stanley Keller metaphysics on integration, but I wonder whether that really is okay.
Technically, it's not okay. You're capped at the $100,000.
We did two separate offerings to the same person.
I understand, but if the way that individual found out about the deal was through the Title III solicitation, do you have it's not going to work. Now, query whether or not that same person you had a pre-existing relationship with, but only learned about it through the Title III, now you're getting into some pretty thorny issues. You probably wouldn't have a real practical problem at the end of the day, but from a technical point of view, it's a problem. And the other issue that's come up, and we went down to see Corporation Finance about it, is you start a Title III campaign, and now you want to withdraw the Title III campaign because that accredited investor wants to take down the whole deal in a 506B.
You maybe have to wait 30 days.
I propose the same thing. The answer is currently no.
No.
What, you have to wait?
We will have to wait to see how this evolves, but currently there is no action letter, although I can think of a good one, where you would withdraw that, wait the 30 days, and then you probably would be okay. But we've asked for guidance and we don't have that.
Okay, we got time for a couple more questions, and then we're going to move on. In the back.
I was wondering if you could say a little bit more about the restrictions on the objective criteria the portals can use to filter out the different investment potentials on specifically like the logic behind it. For example, it says something about restrictions on the can't filter based on the managers of the companies, for example. Maybe that misread that, but does that mean we want to not do individuals, or is it can't criteria about the company?
Yeah, so the question was to kind of explain further the objective criteria that is included in the conditional safe harbor, to be brief. So basically, the whole idea behind it is to try to prevent funding portals from picking certain offerings just because they think they're good investments. I mean, that's because, there's a statutory prohibition on giving investment advice. So you can't really say we're picking this one because of the merits of it as an investment, right? That's just contradictory. So we tried to find a kind of middle ground that would work and still be consistent with that. So we have in the conditional safe harbor a reference to objective criteria that is, I think, applied consistently across all offerings and issuers, reasonably designed to result in a broad selection of issuers or offerings, and clearly disclosed on the platform. So, for example, if you wanted to say, here are the 5 offerings that are about to close, right? That sounds fairly objective. That meets the criteria. Or you say these are the these are the offerings based, in this particular, by issuers in this particular industry, for example, that meets the test. But, when you get into the scope of, these are the ones we think are the best, offering the best investments, that to us just clearly goes against what was in the statute. Does that?
Is he talking pre or post?
Somehow measurable, so like, you could say these are the offerings that project margins at this.
I think one of the things the staff would be comfortable with, if you're giving the control features for the search or the filter over to the individual investor, they can manipulate the information. That's okay. So if you liked a biotech deal last time, the site can't push another biotech deal to you without you asking to see all biotech deals in the future. So that's the sort of difference that the staff's making.
We've got another question that came in. I think this is probably a little too esoteric, but it points out something very interesting that we kind of glossed over.
Richard, did you type this in?
No, so Charles Kaufman. Can you comment on the Trust Indenture Act compliance for a crowdfunded debt offering? Now, okay. Okay. Now, hold it. What I wanted, the reason I asked, that's a whole seminar. So I think we'll pass on the specifics of the TIA. But it points out to me something that we did gloss over a bit, and that is that there are no meaningful rules on the types and terms of the security that you can offer. Debt, preferred stock, common stock, convertible. There are no...
Some hybrid.
Yeah, all sorts of hybrids, whatever you can come up with. Not only that, there are no, I shouldn't say no, there are very limited rules with respect to the nature of the price at which you offer the securities. You can have Dutch auction securities if you structure it properly, correct? You can price your securities in all sorts of different ways. There are rules which relate, and I'm not exactly sure what the time periods are. People who put money or people who subscribe for a funded offering have the right up until a certain point to withdraw their purchase offer. In certain circumstances, when the price is not determined, let us say a Dutch auction security, your ability to withdraw lasts for quite a while. There are all sorts, it's not quite the old Wild West, but there is a lot of opportunity for, I would call it, because I actually agree with Doug on whether this is a good idea, I would call it creative financing, where issuers can come up with some very creative and interesting ways to finance small business startups.
One thing I just wanted to add, that if there are, whatever the security is, it could be this really creative exotic security. Just remember that you have to, as an issuer and through the intermediary, you have to educate your potential investors about the types of securities being offered. So, that kind of creates a disincentive to offer very complex, exotic securities.
Yes. The other way of saying it in maybe a more positive light is that the statute didn't curtail what sort of securities could be done through Title III, and whatever the state charter document would otherwise permit can be offered like any other private placement, so long as you satisfy your educational responsibilities. And as it relates to the Trust Indenture Act, it's in the proposed rules, and it speaks to a potential exemption that may be available, but you have to analyze the facts.
So let's move over to Kieran.
Okay, Tim.
Thanks, Jay. And thanks, Georgia, Dwayne Morris, for putting this on. This is a great event, and happy to be a part of it. I also want to quickly reiterate something Doug said earlier, and be very careful in your 506B versus 506C offerings. There is a lot of confusion, even among lawyers out there. So Doug has some great materials. So that's something to just we're seeing a lot of that in the market. So something to pay attention to. So with that, I want to start by thanking the SEC and thanking Layla for putting forth a really workable proposal. It was clearly well thought out. Our initial reaction was, we were surprised on a few fronts about, some of the things that were in there that were, we think, pretty favorable to, portals and market participants, particularly the, investor verification, as well as the safe harbors that got put in place so that, we know, where the lines are on some of the things we can and can't do. So, I'm going to, in a minute, talk about some of the things I don't like with the statute, but I want to preface that by saying that 90% of it we really liked and thought were well thought out. So with that, I'll talk about two areas where we have particular concern from a portal perspective. Not just selfishly, but in terms of whether the industry can function and whether we can have a viable business model in terms of using the exemption and bringing the the aim of the Jobs Act to life, namely, helping entrepreneurs create jobs. So the first is sort of the liability regime that governs crowdfunding and offerings under the statute and Regulation CF. So starting with the the rule statement under Section 4A(c)(2) of the Securities Act, which came into play with the Jobs Act. An issuer has liability if it makes any untrue statement of material fact or omits to state a material fact required to be stated or necessary in order to make the statement in light of the circumstances under which they were made, not misleading, provided that the purchaser did not know of such untruth or omission, and does not sustain the burden of proof that the issuer did not know or in the exercise of reasonable care could not have known of such untruth or omission. So to answer a question that came up earlier, there is a due diligence defense, but the burden of proof to use that defense is shifted onto the issuer. And so, another corollary point to this is that issuer is broadly defined to include directors, principal executive officers of the issuer, anybody who's sort of engaged in the selling securities of the issuer, as well as the funding portal itself, and their directors and officers, partners. I'm not sure what partners means. So the liability extends, pretty far and wide up and down the chain, and to me, it looks like there's also, personal liability to some of the, the people involved, both at the issuer and the funding portal level. So, some of this can be handled with D&O insurance. I've tried to get some quotes. From an issuer perspective, maybe it's workable because the liability will be limited to the amount of the offering, and so if you have a single offering, you can run an actuarial table on that and figure out an appropriate premium. Though I suspect it won't be cheap. Secondly, with the portals, for us it's a little different in that we may have 100 or 500 offerings, and suddenly you have a very large number that you have an exposure to. So, we have particular concern about the liability provisions extending to the portal. Again, Layla referred to the fact that the portals have some obligation to review the financials or review the disclosure, but can't curate. I think it's asking a lot to ask us to review all the offering statements, take responsibility for every statement in every offering document, and so that's one issue that we're particularly concerned about.
May I just add, it's not going to work if people feel that they've got to do the same kind of due diligence that you would under Section 11 for registered offerings.
Well, there is no Section 11.
I understand
Yeah.
it doesn't apply literally.
Right.
But it's got to be a lesser standard of care as a practice. I know it doesn't apply, but it's not going to be practical.
Yeah. So I think we're all trying to figure out, what the appropriate processes are. But I think we can all agree, what as a standard practice, is an appropriate level of disclosure and fact checking and getting backup. But when you put it in a liability regime like this, you can envision plaintiffs, lawyers taking this as an opportunity to just sue far and wide, and with the burden of proof shifted for the defense, then it's not too hard to make a colorable claim and force a response and maybe force a small settlement. So particularly at the portal level, you can potentially see that people may have somebody buy $50 of securities and use it as bait. So I'll suggest in a second, I don't want to sit here and just complain the whole time. I will suggest some proposed solutions in a little bit, but just to finish up kind of the the statute. So issuer is broadly defined. Liability extends to sort of the directors and principal officers, partners, anybody who's involved in the sale. The measure of damages is effectively, you have to give the money back if so long as they no longer hold security. And again, it applies to the portal itself. So I think this has some practical impacts on who's going to choose to participate in the market. If I'm a serial entrepreneur and I have significant personal assets, do I really want to use this and expose myself to personal lawsuits? If I'm going to start a portal or I work at a portal, now I have to suddenly think about whether I want to expose myself and my family to what could be a large amount of liability. So I think it might have a disincentive, an adverse selection effect where the people that everybody wants in the industry would be scared away, whereas more aggressive players may not worry about it as much. So that's kind of my kind of personal feelings on the issue. So with that, I'll move to sort of a more broader discussion, with practical implications, including liability. We'll talk about liability. This sort of liability regime sort of flows through all of the rest of the cost drivers. So if you are subject to sort of a aggressive liability scheme, you got to be pretty careful with what your disclosure is. And so every time you make a disclosure, you should probably have a lawyer review it. You should probably be very careful what you say, spend a lot of time, and that's going to only serve to increase costs in the end. So I think going back to the core issue is this going to be too expensive for it to be workable? And so to sort of dive into that a little deeper, we can sort of go sort of run down quickly some of the major cost drivers. So starting with initial disclosure. So Doug did a really good job of talking about all the stuff, this disclosure requirements up front. I won't dive into what's required there, but in the SEC's proposal, they said this will probably cost something like $6,000. I've been polling various parties, and there's probably an equal number of people who say that's way too low, and some that say that's way too high. What's clear in the proposal is that they only measure the cost of outside counsel time, and so they did not include the cost of the founders and the team actually trying to gather this information and putting together initial drafts. So I think the proposal said that they expect that 1/4 of the work would be done by outside counsel, and so you say $6,000, that might be 10 or 15 hours from a lawyer in New York or somewhere else. So there are also other industry players who can are saying they can do it much cheaper, something like $3,000, but then they would also require an outside lawyer to be sort of the final review. And maybe in a second, I think Georgia has some interesting potential solutions on this as well. But I think it's clear that we don't really know exactly what it's going to cost, but it is an upfront cost. You also have the financials, which the SEC estimated would be $0 for just a CEO certification. Again, doesn't take into account time of the team. 14,000 for reviewed reports, 28,000 for audited reports. So you can imagine that there is a significant upfront cost that has to be paid before you start your offering and before anybody has any idea if there's any interest in this offering. And so how many people are going to go spend $30,000 or $50,000 to raise $500,000 and not even know if there's interest. So that's one big barrier I see. Just running down, so there's legal fees, which we're all familiar with, portal fees, which may run 5 to 10% of the offering. There'll be probably some kind of software transfer agent service to help keep track of the securities. I've heard $99 a month or something like that, but again, people argue about the amounts. D&O premiums, so as I said before, with the liability regime, you can imagine that the D&O insurance might cost a little bit more. And then we get to ongoing disclosure and ongoing financials. So, again, the SEC in their proposal said that it might cost $4,000 to do your annual disclosure filing. I don't agree that it will be less than the initial filing. I think, a startup in particular will change a lot during a year, and your initial filing will be out of date, and your company will be more mature and more complex. So I actually think the ongoing filings and ongoing disclosures will be much, much more expensive and a much bigger problem in my mind. So. Then we also have the ongoing financials requirement. So every year you need new audited financials if you're above the threshold. Every year you need a new accounting review if you're within 100 or 500K. And so that's that sort of multiplies on itself. So if you say you raised $1 million and you've signed up for ongoing reporting effectively perpetuity, you take a net present value on that ongoing payment stream, and it really, really cuts into what you end up really benefiting from the offering. So, that's the ongoing reporting cost, or another one of my big issues. So, and one thing to keep in mind with all of this is that these costs are really, really borne by the investor. It's their money, and they're trying to get a company funded, and it's going to affect their return. One of the biggest hesitations or concerns with sort of traditional angel investors with these offerings is, I don't want my money going to pay for audited financials or legal fees. I want my money going to hire developers or PR, things that will create long-term value for the company. And so I think it's sort of up to us in the industry to sort of come back to the staff with some practical figures as well as solutions to these issues. So one more kind of I think sort of particularly the ongoing reporting and disclosure requirements may result in some adverse unintended consequences. So for example, if I'm a startup and I have $30,000 left in the bank, and I now need audited financials to comply, or I need to make a filing, do I not make the filings and pay my employees, and then now I'm in violation of my reporting requirements, which I don't think anybody wants to be in that position? Or do I make the filings and then not pay my employees, or do I just dissolve to avoid the whole thing and fire everybody? So these are cash-strapped entities. They'll another possibility is I'll try to do the disclosure myself. It'll clearly be wrong, and then I'll get sued and I'll have personal liability. So
not a good strategy.
So again, I said I wasn't just going to sit here and complain. So, some suggestions that, I have that might be helpful, and obviously would love to hear any suggestions that others have. This is, the SEC has been very good about being open to hearing and sort of paying attention to what the industry is saying and taking feedback. So I think, it's a good opportunity to make an impact. So on the liability front, I really feel strongly that funding portals should be excluded from the definition of issuers for the liability purposes. It's going to be really difficult to operate with kind of this huge exposure, both from an entity level and from a personal level. Again, I think there should also be sort of procedural blocks on the situation where one disgruntled investor or somebody, sort of affiliated with a plaintiff's firm or something like that would, be able to, invest $50 and then bring a security suit. So, I would love to see some procedural barriers where, maybe you need, a certain percentage of the investors to sign on before a suit can be brought, something like that. Again, I'm not a litigator, so you guys probably come up with something better than I can. On the upfront costs, I'd love to see a safe harbor for sort of testing the waters activity. So on Seed Invest right now, we have companies that are sort of in prospect mode, so they're not accepting investments, but there's the ability for people to sort of indicate interest. It's not clear to me whether that would be sort of permitted in this regime or not, but I would love to see some explicit safe harbor or comfort there. Again, on the upfront costs, I think the disclosure requirements should be scaled to the size of the offering, like the audited financials are. So, for example, offerings under 500,000, the disclosure should be limited to what's required by the statute. Again, the SEC doesn't have authority to do less than that, but I think if we think about smaller offerings requiring less disclosure, I think that makes a lot of sense. So, we can all argue about the specific numbers or parameters, but that's a concept that I think should be included. On ongoing disclosure, so the SEC has authority explicitly in the statute to implement exemptions to ongoing disclosure requirements, and so I think this is critical, and just against the backdrop that no other private offering has any ongoing public reporting requirements. So, what I would like to see is, no annual disclosure of financials for offerings under a certain amount. I'll throw out 500K. Again, we can argue about the numbers. No annual disclosure or financials where there is no potential for an investment decision by a crowdfunder. So this means that the stock is non-voting. The stock will be repurchased or liquidated based on sort of certain events occurring, such as an M&A event or a IPO or a next round financing. And then no ongoing disclosure where all the investors have contractually waived their right to receive ongoing disclosure. That's probably a little more controversial, but I think combined with education and sort of clear, a clear indication that people understand what they're waiving, I think that is something that people should be allowed to do. Investors whose money it ultimately is should be allowed to waive this obligation. So that's all I have. Thanks, everybody.
Thank you very much. We've got a couple of other questions that came in from the webcast. I'd like to pose one of them, and then I'm going to ask one question, which is my own, which just for fun for Doug, and because he and I really do agree on this. The webcast question is and this reflects that sometimes the crowd comes up with interesting ideas. With regards to prohibition on a portal providing investment advice, what about a set of standardized diligence/evaluation questions that result in a score? Could the portal show each company's score? In other words, put in a more common vernacular, can you create a FICO score for a crowdfunded issuer and then post the score without violating the prohibition on giving advice?
It's a great question. I mean, it's all going to be very facts and circumstances based, right? It's kind of what exactly are they testing? What is this grading system about? Is the criteria objective? How, you know, if at the end of the day it's really a score to say how great of an investment it is, I think there's a problem. But I'm just thinking about it, how it works, thinking about how it works under the proposed rules. But I mean, at this point, you know, we're soliciting a lot of comment, and to the extent people have ideas that are where they disagree with something, but if they can provide a solution the way Kieran, for example, has provided specific alternatives, I think that is the most helpful thing to the staff at this point.
It's an interesting idea, but when you drill down to the nature of the model that creates the score, there's going to be an evaluation by the portal of the quality of certain criteria, and that's going to come close to advice. But on the other hand, it's an idea worth thinking about.
Well, let me give you a variation on that. It's not under the investment advice per se, but there are technologists who've come up with diligence-related indices. They do background checks on the individuals and the opportunity, and they're scoring them based on risk. Not whether or not it's a good opportunity to invest in or not, but whether or not there is a reputational index, basically. Should you have concerns, they don't have an online profile whatsoever, things like that. And it's not the portal that's doing it, it's a third-party provider that's coming up with the indices. And I understand that that's an affiliated relationship and it'll be attributed back to the platform, but it's not investment advice, it's merely just talking about whether or not it's an anti-fraud protection mechanism.
Well, I think what I want to do is I want to have a crowd-funded offering to create like an institutional investor service, independent company that's going to do independent ratings of crowd-funded offerings, and then the portals can publish. I'm sorry, the issuers can publish their FICO score as part of their package.
Well, if that was your 506B offering, you just blew your exemptions.
All right, here's my question, which I think points out what I suspect, and from some of the things Doug said, I think he suspects are going to be where crowdfunding is going to end up. The question is, can issuers limit who buys their securities? And I'm not talking about whether they can prohibit people who have been involved in class action litigation to buy their securities. Here's the question goes like, I want to raise $499,000 to open a restaurant specializing in humanely raised beef and chicken food sales in Brooklyn. Can I say that I will only sell to people who live in Brooklyn because I want my investors to be invested in with more than money in my restaurant, and I want them to come to my restaurant? See, I think that that crowdfunding makes sense for small local businesses. You're not going to start Facebook with crowdfunding. Maybe you will once in a decade, but that's not going to be the common use of it.
I think you and I agree. I think while there will be there will be entrepreneurs that are not in New York, California, or Massachusetts, that are in smaller cities that are looking to raise up to $1 million, where it could be helpful to them from their community, where it will be technology oriented. So I wouldn't be completely dismissive of it, but I do think it's more likely to be used for community-based projects, like the one that the questioner is asking about. The issues that Layla was addressing before about not giving investment advice with respect to what a crowdfunding platform may not do, that doesn't apply to what an issuer may do. An issuer may exclude people from their deal for any one of a number of reasons. I think it's more of a disclosure issue, like we do in our private placement memorandums, where we leave it up to the issuer to decide who gets in a deal and who doesn't.
Go ahead.
So can you exclude people who've been involved in class action litigation?
I think
I see no reason why not.
I think, isn't there a request for comment on that issue?
There is a request for comment on, can the portal exclude potential investors from their portal site and from utilizing that? Whether or not an issuer chooses to accept someone's money, I think it's an issuer question.
We have any other questions? Over here? Yeah, go ahead.
I have one for Kieran. On your cost analysis, when you talk about the 5 to 10% of the offering
Summarize it.
that.
Just summarize it before you.
I think the question is, so in our cost analysis, we talked about 5 or 10% of the offering going to the funding portal. And I think the question is, can a funding portal take a transaction fee? And I think we believe that we can. As a registered funding portal, you can take a transaction fee.
Based on the amount of the offering?
Yes.
What's the, I'll talk to you afterwards.
Yeah, just so the receipt of transaction-based compensation, you're absolutely right, is often an indicator that someone's acting as a broker and therefore required to register. But Title III basically contemplates that these entities are brokers, right? They're just limited in what they can do. So they can only do Section 4A6 offerings. And so they're exempt from the actual broker registration requirement, but then subject to certain conditions, they must register as funding portals. So that's how it works. So yes, funding portals can get transaction-based compensation. And I think some of the stats Kieran mentioned, like we've heard the same ones too, and these were based on crowdfunding offerings that are not securities-based. A lot, we asked a lot of portals in the process of coming up with the proposed rules, how much do you charge? How does it work? And this is for like perk space or donation space or, other models. So that's, I think that's where some of these estimates are coming from.
There's a lot of the original information on this issue prior to the issuance of the proposal went the other way. Everybody said this can't possibly work because the portals can't make any money. And I think that everybody in reviewing the statute and then clearly as implemented by the proposal recognizes that that wasn't intended, and frankly, it's not what the statute says.
Interestingly, and it's another area where I think the staff was, from a commercial point of view, quite enlightened. I also think from a policy point of view, in the proposed rules, not only does it make clear that a crowdfunding platform is a broker and therefore can get transaction-based compensation, it may enter into relationships with other broker-dealers and fee split with other members, but not on an inbound basis, only on an outbound basis, which is a key distinction. And the policy reason for that is I used the word incorrectly once and Layla shot me down, so I won't use it again. I wanted to say facilitate, but it certainly has a pathway where a broker and a broker-dealer can have a relationship so that the crowdfunding platform can get some of the broker-dealer compliance economics through the relationship so that they comply with AML, OFAC checks, escrow in some cases, and so there will be relationships between CFPs and broker-dealers.
So I have a slightly off-topic question, maybe for your next panel, but related to this, but slightly different. Are we going to end up in a world where the combination of Title II, 506C, crowdfunding, although it's not traditional crowdfunding, you can have now 2,000 investors, 500 accredited without having to register under the exchange. And Rule 144 has been liberalized. That we're going to have tons of major companies in this country, I personally think this is a bad idea, who are going to be real companies that will never be publicly registered. The second market will handle it, and we'll have a huge part of our economy with de facto public companies with no public disclosure.
Well, Blake, you and I have to have some lunch together. Directionally, I'm not a big fan of a lot of this. I thought the whole permissibility towards shares posted in the second market, even though it's not a marketplace that's really working right now because of the Facebook offering, we ought to be encouraging companies to go public. We ought to find ways to have reduced burdens on smaller issuers. But you're right, but there, and I'm working on it, is in Title III and Title II directionally to find a way, and that's why, and I'll be careful, Kieran, here, not to mandate, but to encourage these issues, Title II in particular, to start becoming public-like, because the technology capabilities now that can enable that kind of communication is so inexpensive and available, so that after a year, they can be trading on the OTCQX or marketplaces, and not shares posted or second market, which are dark markets.
Right.
And I think that if you look at the proposing release, you can see that the SEC did envision this Title III crowdfunding to be a stepping stone. And this was a step one for a company to start coming into the public light and start, having public shareholders. And then, as it gets larger and becomes more sophisticated, will grow and develop into a true reporting company.
On the other hand, from the point of view of someone who is, has an issuer that is scheduled to file a Form 25 day after tomorrow, it's expensive to be a public company. This is not cheap. At least $150,000 a year. And that was a cheap estimate that my client did, and decided the benefits to them, and more importantly, the benefits to their shareholders, because they were still trading by appointment, and their average daily trading volume was still, I don't even think, one full unit. There was a reason why Congress increased the 12G limit, and I think it was in recognition of the fact that there are a lot of companies out there for whom public registration is a big burden. I don't disagree with the idea that transparency is good, the ability to get information about your company is good, and all that is wonderful, but it is a rather expensive industry that, frankly, some of us make a fair amount of money on, but let's be realistic. One more, and then we're just about the right spot.
There's also a strong sense, if you look at the whole private equity industry, there's a strong undercurrent that public reporting is a horrible thing. It's a terrible thing. Quarterly numbers, annual numbers make managers play to the numbers rather than play to long-term value. And there's a serious possibility that at least some of the companies going into this can go and try to attract investors who say, you know what, I don't care about public trading. I don't care about ever selling my shares. I just want to get in, make money. I'll call you 20 years from now or 10 years from now to trade out by appointment.
Well, I think we'll conclude on that by noting that at the full meeting of the business law section a year and a half ago at Cornell, Professor Lynn Stout, who is fairly characterized as a well-known corporate economic legal gadfly, strongly made that argument as a much better way of fostering quality corporate performance. And with that, thank you all for coming.